Even though the economy in 2023 appears unsteady due to high inflation, the Federal Reserve's decision to increase rates, and the stock market's decline in the last 12 months, several top investors have been actively purchasing shares. The trend of top investors buying during market crashes is not new. This strategy has proven to be successful in the past, including during the crashes of 2001, 2008, and most recently in 2020. However, to ensure success, it is critical to follow 3 fundamental investing rules. Mohnish Pabrai elaborated on these rules, which we will discuss shortly. One of the 3 essential investing rules, especially during times of economic fragility and high inflation, is to seek out companies with a lasting competitive edge. Mohnish Pabrai suggests that if a new business, such as a Thai restaurant, is opened in a small English city and does well, it may attract more entrepreneurs to open similar businesses in the same area. As a result, the economic viability of these types of businesses in that city may eventually become comparable to other areas in England. Furthermore, Pabrai says that in capitalism, when a company develops a better product or service and becomes successful, it also becomes a target for competitors who will try to enter the same market and compete by offering similar products or services. These competitors will attempt to diminish any competitive advantage the original company may have had, which can reduce profitability. It is crucial to remember that being first in a market may work initially, but it is not a guarantee of long-term success. Examples like Snapchat, Atari, and Motorola demonstrate that being a pioneer does not necessarily lead to sustained dominance. Instead, investors should focus on identifying companies with inherent characteristics that give them a sustainable competitive advantage that cannot be replicated by others. This enduring competitive advantage is commonly referred to as a moat, and it is a crucial concept in investing. Repeatedly, it has been observed that brand moats are the most potent. An example of this is Coca-Cola, which was proven to be less popular than Pepsi in blind taste tests. However, with the label, Coca-Cola remains the world's leading drink. Thus, companies with highly desirable and recognizable brands possess the strongest moats, making them some of the best investments, even during difficult economic times, which may seem counterintuitive. Having a moat implies that customers will continue to patronize a company's product or service and are less likely to switch to a competitor. This is particularly advantageous during tough economic periods, as customers are more inclined to stick with what they know and trust, even if it may be more expensive than alternatives. Although having a moat is beneficial, investors should bear in mind that no moat is permanent. As a result, it is essential to continually monitor the durability of a company's competitive advantage over time. Mohnish Pabrai suggests that capitalism is a system where new businesses are constantly emerging, but few of them are able to survive and thrive over the long term. Many businesses fail within their first year, and the survival rate decreases significantly for those that make it past their 5th, 10th, or even 13th year. Therefore, over time, the competition in any given industry or market will become more intense, making it more difficult for businesses to maintain their competitive advantage and survive. Pabrai adds that, as investors, it is important to evaluate businesses not only based on their current position, but also on their ability to maintain their competitive advantage in the future. This is a difficult exercise because there are always competitors who want to take away a company's advantage and profits. However, this is also what makes investing exciting, because figuring out how a company can maintain its competitive advantage is not straightforward. Apple is an example of a strong company with a significant brand and switching moat. However, as an investor, it is crucial to keep a close eye on the strength of a company's moat over time, even for a stalwart like Apple. One way to evaluate a company's moat is by examining its long-term track record of revenue, earnings per share, free cash flow, and equity. Investors should ensure that a company consistently grows at a rate of over 10% per year to confirm the durability of this moat. Therefore, identifying companies with a moat is the primary lesson in successful value investing during tough economic times. However, let's shift our focus to another critical factor that Mohnish emphasizes. For him, as value investors, patience is one of the advantages they have. They may not have an information edge, meaning that the information they have about a company is not unique compared to what others have access to. However, they can potentially have an analytics edge, where they can analyze the same data as others, but come to different conclusions. This analytics edge can be a real advantage for value investors. Mohnish Pabrai suggests that having a longer time horizon can be the strongest edge for investors. He cites Jeff Bezos, who believes that many competitors are focused on the short term, while Amazon takes a longer view of 5 to 10 years. By investing with a long time horizon, Amazon was able to gain an edge and make investments that may not pay off for several years. Therefore, having a long-term perspective and patience can be a significant advantage for investors. This principle not only applies to companies but also to us as investors. Having a long-term perspective is crucial, particularly for value investors who manage their own money. It gives us an edge since we aren't under pressure to make immediate profits and won't be forced to exit if we don't achieve a certain short-term return. Active funds on Wall Street are often caught up in a short-term game, focusing solely on quarterly returns. However, long-term value investing, according to Mohnish, requires patience. As value investors, we look for opportunities to purchase exceptional companies at a favorable time and then simply wait. Although it may seem tedious, patience and inaction are crucial in this game. We wait for the crisis to subside and the recovery to begin, which could take anywhere from 1 to 5 years. By patiently waiting for these opportunities and focusing on holding onto these businesses for the long term, we can ultimately profit. Pabrai believes that one of the reasons why the index does well is because it has the ability to think long term. The index does not know which company it owns, so it doesn't sell them, and it holds onto them indefinitely. This long-term perspective is an advantage because it allows the investor to benefit from the compounding effects of holding on to successful companies over time. Furthermore, for him, one of the strongest edges an investor can have is a longer time horizon, as demonstrated by the success of index funds like the S&P 500, which can hold onto great businesses such as Microsoft, Apple, Amazon, or Alphabet for decades. In contrast to actively managed portfolios, index funds can avoid selling companies on the rise or buying into those that have already peaked, providing a significant advantage over the long term. It's astonishing to consider that the S&P 500 outperforms more than 90% of active fund managers in the long run. This serves as a compelling example of how a short-term mindset can hinder an investor. As value investors, we focus on businesses with proven competitive advantages or moats and aim to hold on to them for an extended period. By adhering to these principles, a significant portion of long-term risk of loss can be mitigated, even if valuation mistakes are made along the way. Pabrai also suggests the second approach of investing in a great compounder, even at an expensive price, can lead to great results due to people not looking at the right time horizon. He cites examples of Microsoft and Walmart, where paying any multiple at the time of their IPO would have resulted in substantial gains. He believes that if one had a crystal ball that can predict a company's future 30 to 50 years from now, investing in a billion-dollar market cap company could result in a market cap of $200 billion. The significant advantage of this strategy is that it is ultra-long-term focused and targets high-quality businesses with substantial competitive advantages. Even if these companies are purchased at a premium price, they could still be worth considerably more in 10 to 15 years. This doesn't imply that valuation can be ignored, but it's reassuring to know that buying a high-quality business at a fair price can be just as profitable as buying it at a bargain price. Another crucial point that Mohnish emphasizes is the importance of not selling a big winner, especially after finding a business with a wide moat, committing to owning it for the long term, and buying it at a fair price. Unless there is a fundamental change, it is better to hold on to the business and allow it to compound for a decade or two. Amazon, Google, and Tencent are excellent examples of companies that have achieved multi-bagger status by compounding over 20 years. It's essential to resist the urge to sell the winners and instead focus on watering the flowers and cutting the weeds. In summary, the formula for value investors to profit during tough economic times is this. Firstly, find companies with intrinsic characteristics that set them apart from others. Secondly, hold on to these companies for the long term. And lastly, avoid panicking and selling before they have a chance to compound. These are the 3 key lessons from Mohnish that can help investors succeed during economic crises. It's crucial to remain rational and level-headed throughout the process. But what do you think? Which companies are you investing in soon? Comment your thoughts below. Thank you so much for watching. If you haven't already, hit the like button, subscribe to the channel, and turn on notifications to stay up to date with our latest uploads.